Welcome back everyone. Today's episode is a little bit different. Normally we focus on undervalued companies like Novo Nordisk, where the forward PE sits below the 5-year average and the dividend yield in fact sits above, both strong signs of undervaluation. Plus the blue tunnel also confirms it. We can see the current price today sitting below even the bottom band, which as always the blue tunnel highlights the intrinsic or fair price, pointing to a clear discount for NVO today. But today we're flipping the script. We're looking at 10 stocks that are showing the opposite signal, companies that might be overvalued and even worth considering a sell right now. We're not going to look at Apple in detail as we covered it yesterday, but the signal is very clear. Forward PE sitting above the 5-year average, as noted here, 33 versus 28. And the same signal to be noted when we look at the blue tunnel. We can see it is above even the upper end. Now for context, yesterday's session was fairly mixed across the S&P 500, but over the past 4 weeks, we're actually seeing many of this year's strongest performers. They're still climbing, even up double digits in just a matter of days. And retail investors have just poured $100 billion into stocks, the largest 1-month buy in history, even as 91% of fund managers now say that US equities are overvalued. We even have JP Morgan CEO warning of a potential correction, and he's pointing these to uncertainties around tariffs, immigration, geopolitics, as well as President Trump's tax and spending policies, all of which are long cycle factors that still could play out. And in the AI space, we're also seeing some very strange signals. Bear in mind, we're hearing that OpenAI are still going to be conducting a lot more deals. We're talking in the billions and billions of dollars. And we've heard Nvidia's CEO coming out to say that OpenAI does not yet have the money for some of its massive hardware deals. And just bear in mind, these are all of the companies that are currently in some way, shape or form in contact with OpenAI. So it remains to see whether or not this will all pay off, or in fact this was the tipping point to really burst this bubble. And if you remember, towards the beginning of the year, we heard that Microsoft paused several of their data center projects, something that we're seeing in just the last few days, although this particular scenario was more of a pushback from the local community. And let's not forget about all the power that is needed. In fact, the power demand for AI is projected by Bloomberg to quadruple over the next decade. So with investor sentiment sitting in neutral, markets in fact hitting new all-time highs, a record close as noted for the 33rd time in 2025, and key valuation metrics like the forward P, like the price to earnings growth, like in fact the EV to EBITDA and the price to sales, all flashing red. Today's episode could not be more important, so let's dive into the 10 stocks that might be overvalued today. Now the first one we're looking at is Broadcom, up a mammoth 91% in the last year, year to date up 49%, over the last 10 years significant outperformance of the S&P, up more than 2,700%, and they're trading very near to all-time highs at $374. Still, Wall Street give this company a strong buy. Seeking Alpha very weak because 3.5 is what would tip it into the buy rating, so they are clearly on the fence. And we see massive disparity between the forward PE, which sits at 41, and the 5-year average of 18. Also couple that, on a 5-year average, they offered investors a yield of 2.6%. It's now heading towards 0.6%. And on the blue tunnel, we can again see the disparity massive. In fact, this is one of the largest we have ever seen when analyzing companies. Although yes, great to see the blue tunnel intrinsic price increasing over time, but not only the disparity, something we've seen for over the last year, where if we were to zoom out to the last 5 years for Broadcom, it's been pretty much trading at such a massive premium from the middle of 2023. And what's even more fascinating to note, this one very rarely enters an undervalued signal. You would have to go to the end of 2022. And the other thing we'll do before our own valuation is the valuation grade itself. They're trading at a 99% premium to the sector overall, a 118% premium to their own 5-year average based on the forward P. But if we were to look at the price to earnings growth, 1.73, not too bad, as typically we like to see below 2 for further investigation. Sector sitting a little bit higher, so a 6% discount. but against their own 5-year on the PEG, it is at a 21% premium. Now, our intrinsic value at $258 derived from the DCF is based on a growth rate moving forwards at 20%. Yes, average is 33, but over the last year we saw 10%, year prior to that at 8%, so 20% in fact does give 258, which indicates downside of 25%. Bear in mind, on a reverse DCF, this highlights baked in today if you're adding at $343 is 24.1% growth to the future free cash flows. If you see that as too high right now, then already overvalued. Vice versa, if you believe this is too low in fact, then undervaluation. Also, these numbers are subjective. You can always grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for Broadcom or any others. But as we can see, growth rate and the discount rate gives us the present value of future free cash flow, terminal price, add together with the cash, subtract total debt, get to the equity price, divide by shares outstanding, 258, downside of 25. If you want to be even more conservative at 15%, well, intrinsically $179, downside of nearly 50%. And if we want to go the other end, 25%, then yes, intrinsic value is higher, but we're only talking about 7% upside. And as we typically do, middle rate of 20%, we're not done there because when we buy quality companies, we want at least a margin of safety of 10%, where we execute buy if it meets the 3 criteria: wide moat, strong financial metrics, good forward-looking data. That would indicate a buy at $232, already telling us, as of today, if you're adding, you're not getting an MOS, you're paying a 33% premium. Now look, if you wanted to make a note, at 10%, a buy at $232, at 20%, $206, and at 25%, $194. Now, it may never get to the point of those targets, but just something to bear in mind if you are buying. It looks to be trading at a premium. Wall Street, even with their strong buy, see this at $377 into next year, only 10% upside. So let us know, Broadcom stock number 1, if you see it as a buy, hold, or avoid. Before we continue, we want to let you know we have released our latest free weekly article. We drop one every single Monday morning covering severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up and read straight away, where you'll be able to gain access to severely undervalued stocks for the month of October. Lots of information for each one, the upside that Wall Street themselves see over the next year, and on top of that, you can grab a spreadsheet of stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. The next stock we're moving on to is American Express, up 20% in the last year, up 9 year to date. Over the last 10, nice outperformance, up 319%. Trading not too dissimilar from their 52-week and all-time high. And for the first time that we have seen in quite a while on this channel, we get a triple hold right across the board, where we see the forward P at 20 above historical 18, yield also a little bit lower at 1 versus historical 1.2, and on the blue tunnel we also note it does sit above the upper end. In fact, Liberation Day you could have bought this undervalued, but more often than not, American Express in the last 12 months has been trading at a bit of a premium, where when we do zoom out to the last 5 years, this one again very rarely trades at an undervalued point. As always, make sure you're subscribed, notification bell is on. High quality companies like AXP, when they enter severe undervaluation, we will flag. And they also get a poor valuation rating at an F, where if you're looking at a forward P, you're paying 91% premium to the sector, 12% to their average, and a price to earnings growth 1.69. It is above the sector, so 47%. And again, a premium to their own 5-year, although smaller at 8.4%. Now, our intrinsic price comes to $328. What we can also do is highlight the DCF, where we do in fact use a growth rate of 4%. What's being highlighted though today is that in a reverse DCF, it is coming at 3.4, maybe giving you a little bit more depth if you want to incorporate some of this analysis in your own investment thesis. But overall, 328, indicating pretty much it is trading, in our view, around its fair price, a 1.1% MOS. Wall Street with the hold give this $340 target into next year, only 5% upside. And if you wanted the different rates, well, at 10%, a buy at $295, at 20, a buy at $262, and at 25, $246. Stock number 2, AXP, let us know your views. We then move on to Taiwan Semiconductors, up 64% over the last year, 54% year to date. Over the last 10, huge outperformance, up more than 1,000%. One that we talked about a lot. We love this company when it was trading near its 52-week low. Now, in fact, it is trading at a new all-time high. Still double strong buy from Wall Street and Quant, and a fairly respectable buy from Seeking Alpha. But we do see the forward P at the 30 mark, which is well above historical 22. Yield slightly lower, 1.1 versus 1.7. And the overvaluation signal here, we can note, in fact, pretty much for the first time in the last year, this one is trading above the upper end. This is a good point here just to understand, if you have patience, more often than not, companies that you like will enter into an undervalued scenario. But as we can see from TSM, today it is trading in the overvaluation space. Zooming out to the last 5 years, again, another clear indication that if you have patience and you're not just jumping in straight away, you can in fact consider companies when they do look a lot more attractive. And this one does get a D+, trading at a premium on a forward P on both aspects. On a price to earnings growth though, actually looking attractive at 1.3, well below the sector at 1.9, so a 28% discount. But our intrinsic price at $285, the average of the four, highlights that actually you're paying a premium today of 7%. On a DCF, actually we get to 211, so a lot lower, but we are factoring in a 15% growth rate. If you were to use the higher rate at 20%, then 282. Nonetheless, all three scenarios here indicating downside, and on a reverse DCF, 21%. So trading at a premium of 7%, 10% MOS, a buy at 257, at 20, a buy at 228, and at 25, 214. Wall Street indicating themselves with even their strong buy rating, seeing this at 295 into next year, downside of 3%. Maybe you agree with TSM, it isn't one to buy, maybe you see it as a hold, or maybe a complete avoid. Do let us know. We then move on to Lam Research, up 76% over the last year, up 97% year to date. Over the last 10, nearly up 2,000%. Another one we really liked and we discussed near the 52-week low. Now it is very near to its all-time highs, and we get a double buy from Seeking Alpha and Wall Street. Seeking Alpha though, fairly weak, where we notice a forward P of 32. That is near enough one of the highest it has ever been in the last 5 years, the average around the 21 mark. Yield also sitting lower, where we also note when we do look at the blue tunnel, massive disparity, something that's only increased in just the last few weeks. Again, highlighting the point, if you have patience, severe undervaluation does show up in many companies. Zooming out to the last 5 years though, this one did go through quite an extended time of trading at a premium, meaning in fact it may not come back down into the reasonable signal for quite some time, but that doesn't necessarily mean you should jump straight in. And then we look at the valuation grade, where they get an F, premium on both accounts at a forward P, 23%, 52 respectively. Price to earnings growth, 1.8, not too dissimilar from the sector, but actually this one has historically traded higher, hence why we do get a 16% discount on the price to earnings growth. Now our intrinsic price, $130, where the DCF comes in slightly higher, indicating on a reverse basis, 10.5%. We've used pretty much around that at the 10% mark. Nonetheless, as of today, it's trading at a 10% premium. 10% MOS, well, a buy at 117, at 20%, 104, and at 25, $98. Wall Street themselves, even with their buy rating, see this lower into next year at $120. That is downside of 16%, but let us know your thoughts on Lam Research today. We then move on to JP Morgan, where we just heard the CEO talking about the current valuations, up 44% in the last year, 27% year to date. Another massive outperform of the S&P, trading very near all-time highs. A double buy, although fairly weak, it is below 4 out of 5, and we can see the forward P above 15, historically below 13. Yield only marginally lower at 2 versus 2.5%, and we do in fact get that overvaluation signal, but this one more often than not has been trading at a slight premium over the last 12 months, where if we do zoom out to the last 5 years, we get a clear indication this company's traded in a reasonable signal, traded undervalued, and also traded at a premium in the period, so definitely something just to consider. Where it's trading at a 40% premium to the overall sector, 29% premium to their own 5-year, and a price to earnings growth a huge 94% above the sector, 2.2 versus 1.2. Now our intrinsic value at $275, another company with a premium around the 10% mark. If you wanted to buy it 10% MOS, $248, at 20%, $220, and at 25, $206. Wall Street themselves, minimal upside again, $325 into next year, 7%. JP Morgan, is this one worth considering today as a buy, hold, or in fact a sell? We then move on to AbbVie, which is up 20% in the last year, year to date up 30, over the last 10, more than 300%, trading at the upper end of the 52-week range, a double buy from CE Alpha and Wall Street, where we notice the forward P of 18 sits quite some way above the 5-year of 13, yield 2.8, a lot lower than historical 3.9, and another overvaluation signal. In fact, this one has been trading at a premium over the last year, something that when we zoom out to the last 5 years has been a continued premium, where in fact if you wanted to buy this at a discount you'd have to go to around 2021. Otherwise, this one in fact for the last 4 years has been trading at a premium, where we notice it's 9% above the sector, 57% above their 5-year, and a price to earnings growth at 1.2, a lot lower than the sector. We're talking a 34% discount. So our intrinsic value at $224, not too dissimilar solely from looking at a DCF, where we've used 7%, pretty much that is what is baked in at the current price today. And overall, we actually see this company trading at a very small 3% premium. So you could say this one is there or thereabouts in terms of a fair value. That is what Wall Street also see. No upside into next year. $230 target. Now a 10% MOS would make this a buy at 202, at 20% 180, and at 25 $168. AbbVie, let us know your thoughts. We then move on to Dell, up 35% in the last year, 43% year to date, up 140% over the last 5. Another one we spoke about a lot near 52-week lows, now sitting at its 52-week high, where we get a strong buy from Quant, very close to a strong buy as well from both CE Alpha as well as Wall Street. But the forward P does sit quite high at 16 versus historical 10.7, yield 1.3 versus 2.2, and the blue tunnel also signaling overvaluation. There was a very short time in this period where we could see reasonable / slight undervaluation, and interestingly it's trading at a 33% discount to the sector, 61% premium to the 5-year, again on a forward P. When we look at a price to earnings growth though, on both accounts, 38% discount to the sector, 10% to their own historical. In our intrinsic value coming to $174, as always the average of the 4, which you can grab a copy by clicking on the pinned comment below. DCF $201, reverse DCF only 1.3% today. We have used a 4% moving forwards, which in totality gives us for the first time I believe a margin of safety sitting around 5%. If you wanted 10%, well, a buy at $156, at 20% a buy at $139, and at 25 $130. Wall Street themselves, very minimal upside, $170, only 3%. Maybe you agree, maybe you disagree. Do let us know. We then move on to Caterpillar, up 29% in the last year, year to date up 38, over the last 10, strong performance, up 621. We also notice pretty much trading at an all-time high, just 1 week buy rating from Wall Street, where just look at that, in the last few weeks this has really shot up. Forward P 27 versus historical 16.8, yield 1.2 versus 2 on the dot, and we can also see here the overvaluation, something that's pretty much started from around July, August. Prior to that, it was trading in a reasonable signal. And zooming out to the last 5 years, this one actually, if you really want to see it again trading at a massive premium, you'd have to go all the way back to 2021. More often than not, it does give you lots of opportunities to buy severely undervalued. And a D- on the rating, 33% premium to the sector, 52 to their 5-year. Price to earnings growth 4.3, well above the sector, and in fact 161% higher than their 5-year average. In our intrinsic value, 404, where the DCF comes in lower at 378. We've used 5%, baked in today is around 8.4, but overall gives rise to a huge premium of 25%. In fact, if you want this at a 10% MOS, a buy at 364, at 20% 323, and at 25 303. Wall Street themselves, they see downside of 8% into next year, 465 price target. Let us know your thoughts today on Caterpillar, whether you agree or maybe you disagree. We then move on to UNH, down 36% in the last year, down 27 year to date. Over the last 10, it has managed, even with the huge drop, to outperform, up 208. trading around the lower end of the 52-week range for the first time we've seen today. Two respectable buy ratings from Seeking Alpha and Wall Street, but we noticed from the lows where the forward P was in the 12 range, now sitting at 23, that is above the average of 20, so potential overvaluation, yet we note the yield sits higher at 2.4 versus 1.4, but we do get that overvaluation signal here, in fact for the first time in the last year. We're also worth highlighting the intrinsic value has dropped sharply in the last few months, but interesting to note before 2025 this company for quite a large portion was trading at a premium before in the last few years trading in a reasonable signal. Now we notice for the first time pretty much since 2022 this company looks to be trading at a bit of a premium, although worth highlighting when they do release their earnings, if they do show some strength in the EPS, perhaps we will see this change from overvaluation to undervaluation, with the blue tunnel intrinsic price moving in the upwards trajectory. In terms of their grading though, they get a B-, 23% premium to the sector, 11% premium to the 5-year. Now our intrinsic value, if you've seen our in-depth dives, is a little bit more complicated, where we have in fact two different results. We have the intrinsic price at 305, where we have used all four models. This would give rise to a premium of 22%. Now also worth flagging that Wall Street themselves see this at $360 into next year. That is downside of 3. But if we were to look at the case on just a DCF and DDM, for those in fact who believe the issues United Health has faced is more short term than medium to long, then this may be more appropriate. So this includes DCF and DDM. Firstly, on the DCF, $550, we have used a growth rate of 5%. Baked in today is pretty much flat. That could give you straight away a signal that unlike the data we've just seen, maybe the company is undervalued. And using that, you can see here a 16% margin of safety. On both accounts though, we will show you the different rates. At 10%, if you want to incorporate every single one, a buy at 274, at 20, a buy at 244, and at 25, $229. On this one, if we were to use in fact a 20% margin of safety, because already baked in today is 16%, a buy at 355, and at 25%, a buy at 333. So give us your thoughts on United Health. I'm sure some people still believe this is extremely undervalued. Some people don't even want to touch it. And for others, this is one on the watch list. We then move on to Starbucks, which is down 17% and typically does pop up when we cover these type of episodes. It is in fact year to date down 12 as well. Over the last 10, up only 34%, and even with it trading near its 52-week low, we get a sell signal for the first time today from Seeking Alpha at 2.4, a very weak buy rating from Wall Street at 3.65, and a hold from Quant, where we notice on a forward P 33 above the 5-year average at 29. In isolation, that already looks fairly high. Yield 3.1, so it is above the 5-year at 2.3, but bear in mind the dividend safety score comes in at 60, borderline safe, something we can look in detail if you're interested in another episode. And when we look at the blue tunnel, we also get overvaluation above the upper end, something we've seen quite a lot this year. And zooming out to the last 5 doesn't really instill faith when the intrinsic value has been on a bit of a roller coaster ride rather than the consistent upward trajectory we want to see. And they get a D on the valuation grading, 110% premium to the sector, 18% premium to the 5-year average. Price to earnings growth 8.4, 370% premium to the sector, nearly 200% premium to their 5-year. And our intrinsic value $75, not too dissimilar from the DCF, where we've used a growth rate of 7%, just under 8% is baked in today, and this gives rise to a 7% premium. If you wanted to buy at 10%, well, $67, at 20, $60 on the dot, and at 25, $56. Wall Street, though, this is one they disagree, unlike the others. 102 into next year, even with the weak buy rating, that is 28%. So let us know your views on these 10 stocks today, whether you agree, disagree, in fact a buy, hold or avoid category. And if you enjoy these episodes, we can continue to do more, showcase others that do look to be overvalued, ones that we haven't gone in today. For example, we have Hershey showing the overvaluation signal, the same with Cisco, Nike, Norfolk Southern, RTX Corporation and Oracle. As always, don't forget to sign up to the free weekly newsletter, grab those spreadsheets, come and join us at Patreon where we cover our buys and sells, and as always, have a great day. We'll see you all on the next one.